Well, welcome everybody that's attending here. I'm grateful to be presenting to you today the second of my monthly webinar series focused on what BlackGate does and some of the importance of private real estate investing as I see it in the greater picture. Today, we're talking tax benefits of real estate, depreciation, cost segregation, 1031s, and probably what's most important to you guys, year-end moves to take advantage of all the benefits that come from real estate investing and specifically the private real estate, asset real estate investing that BlackGate and other groups do. Many of the names I'm seeing on my attendee list are familiar names, but for those of you that don't know, I'm Evan Polaski, Director of Capital Raising here at BlackGate Partners. But beyond my day job, I've also owned more than a handful of single-family rentals throughout my life, going on 15 years now. On the single-family side, my wife and I do some fix and flips. And I have some passive investments as a limited partner in various syndication type investments like BlackGate does across multiple asset classes. So a lot in retail, a good number in multifamily specifically, but have worked and reviewed industrial office buildings. Actually just got a hospitality offering today that I was looking at. So have a good amount of experience in the space in general. So what are we going to cover today? Obviously, why we're here, we're going to be talking about tax efficiency within real estate, how that can create tax efficiency income and gains and help you really grow your net worth, your income in a more efficient manner over the long term. The biggest piece here that I will say at the bottom, a lot of what I'm sharing, well, I will say I am not a CPA, I'm not a tax attorney. So I'm sharing this in sort of general knowledge and educational purposes, as well as some anecdotes as to what I've seen personally. Now, we're all in a different investment strategy, and our portfolio looks different to each of us. So this is something where to get that real in-depth knowledge for your personal situation, you need to talk to your tax advisor, whether that be a CPA, tax attorney, or others that know the nuances of both your goals and your investment portfolio, as well as how you get your income to really capitalize on all of these. So these are high level, hopefully applicable, and if nothing else, educational and lead to some questions that you might want to ask for your tax preparer of things that you might want to be able to take advantage of. But we're going to be talking about the high level, creating income in a tax efficient way through real estate, and then diving into some more of the details through depreciation and cost segregation studies, and how you can maximize those pass-through losses, longer-term 1031 exchanges, some things to be thinking about as we're about 45 days from year end, and any potential moves you want to make before the end of the year, if possible. And of course, the Q&A discussion. So always open to questions and answers. I like this to be, while you all are muted, there is a Q&A option at the bottom of your screen that will show up on my screen. So if you're thinking of things, please type it in. If it's making sense in the conversation, I'll try to filter it in right away. If not, we'll work through those at the end of the webinar. Given the amount of people here and the potential for a lot of questions, a couple rules on this is I will be sharing this later. If you're having personalized type questions that are very nuanced to you specifically, I'll be following up with you. Let's hop on a quick call. Like I said, I'm not a tax advisor, but happy to give some advice or lead you into some questions that you can be asking of your tax advisor for those nuanced questions. And there is always that slim chance that I get too many, and we're not going to be able to get them all answered live on this Q&A within the time restraints. But please ask them. I get a log of those, so I'll make sure to get those all addressed. And if you ask them with your name versus anonymous, I know who to follow up with should we not get to your question live. But with that, let's dive in. So why real estate is so tax efficient? The biggest reason here is that it allows for, the nature of of real estate through both cash flow and depreciation. And by being a physical asset, it allows you to depreciate it. So you're going to hear a lot of what I'm talking about. A lot of this is talking about different ways that we utilize depreciation on our assets to help shield that actual income that's coming from the properties. Because this is a non-cash expense within the real estate world, when I started in it back in, I guess, in college in the early 2000s, the ideal real estate investment is something that's creating you day-to-day cash flow but showing a taxable loss. So not only are you able to shield the income that you're receiving from those recurring rents that are coming in, whether it be the resident renting your single family house, or in our case, the Chipotles and Starbucks of the world that are paying their monthly rent to occupy our retail real estate. But you're creating those non-cash losses, those depreciation losses, to help not only shield that, but potentially use in other areas of your portfolio that might not be quite as tax efficient. One thing I should definitely hit on here is a lot of what we're talking about is tax deferral strategies. Now, there are ways to defer almost into perpetuity. Some things need to line up correctly. But I never want to say, I always say this is tax efficient, as I've said, and it's not a tax-free investment. There are times where taxes might come back, and in certain cases, because of all those deferrals, they come back actually in an efficient way, but a big number, effectively. Um, but ultimately, the goal here is, particularly for a lot of our investors who are already high income earners, they're trying to, they've moved potentially away from, hey, I need the best returns out of my investments and potentially taking on additional risks that might not pay off, to, hey, how do I keep more of what I already have earned and really shielding that. And that's, again, one reason why I see real estate is one of very few asset classes that can create kind of that whole combination there. And of course, I have to include a lovely quote here through Andrew Carnegie: 90% of all millionaires become so through owning real estate. And I see that both as true in and of itself, as well as it being a great tool for those that have already created a good net worth to continue to grow that, but in a very protected type of way. So the core of all of this, in all reality, is depreciation. This is, a tax rule that says that things wear out. So it's true about your car if you're a small business owner, your computer if you're writing those off for the businesses or consulting companies that you run, and it's true for the buildings as well. Um, Typically, there's two main depreciation schedules that real estate fall into, and that's the 27 and a half year for residential properties. So think your apartment complexes primarily, any investment properties. So even if it is a single family rental or an Airbnb, uh, those would kind of fall under that schedule. And then you get into the commercial space, the retail that we do, office buildings, industrial complexes, where you're on uh, a longer, broad depreciation schedule. And as noted in the lots of words that I put into this, but I'm trying to summarize, ultimately, you take your total basis in the property. You do need to reduce, you cannot depreciate land in all reality, but you can take that number, divide it by 27 and a half years if it's a residential property, 39 years, and just straight line depreciation throughout that. And depending on how much cash flow you're making, that can shield a significant, if not all of it, type of return. So in the real world example that I've got on the bottom right, you invest $100,000, it's creating 8% return. You get $3,600 of that reduced back to depreciation, and you're offsetting some of that 8K. So you're still getting that tax efficiency in terms of only having tax. You collected $8,000 in annual income through the rents after you've paid your expenses, but you're only taxed on $4,400. So if you're like many of the high net worth investors, you're at a high tax rate, you can save $1,200 plus dollars a year in this example, just by using that straight line depreciation. But where depreciation really comes into play, particularly in the commercial space, is through accelerating that. And we do so via what's called a cost segregation study. But the moral of the story is when you're buying an operating business that in many ways real estate is, let's say we're buying Kensington Park, a deal that BlackGate just closed, we're buying the shopping center and the income stream that's coming off that, but we're also buying the parking lot and the sidewalks and the lighting. Um, in vacancies, we're buying some of that carpet and other things that we might be responsible for as a landlord, at least in the build out side. And those you can reclassify into different depreciation schedules, typically your 5, 7, and 15-year assets. Um, Now, in the current tax code that was passed by President Trump earlier this year, they reverted that back um, in the big beautiful bill, as it's referred to. Uh, they've reverted back to 100% bonus depreciation. So now I'm getting ahead of myself, but by reclassifying those and using an engineering study that kind of looks at all of the different components of that shopping center that you just bought, not just the broader, I bought this property, and classifying that into different asset classes, you might have $1 million that fall into the decorative lighting, the specialty equipment, that 5-year classification. And now instead of taking that $1 million divided by 39, you take that $1 million and divide it by 5, getting $200,000 a year of additional benefits or additional depreciation that you can utilize today. Same with the 7-year and the 15-year, based on what cost of that total purchase price was allocated into those types of assets. And of course, your main structures, your enduring structures, your land, those would still remain in that 27.5 or 39-year tax or depreciation schedules. But ultimately, that's one way that you can start to accelerate and gain more depreciation in current years or future years relative to my real world example of you only get $3,600. Now maybe you're getting, you know, $4,500 to $5,000, and your taxable income's coming down even further on that $8,000 of cash flow because of accelerating it through the 5-year and 7. And then ultimately, as I already alluded to, we're getting we've been reverted back to 100% bonus depreciation. So this is sort of um, the big driver here. This took effect actually back in the coming out of the financial crisis for the Tax Cut and Jobs Act, which instilled 100% bonus depreciation on the 5, 7, and 15-year depreciation schedules. So that means instead of taking your $1 million that's in the 5 years, it now can all be written off this year. Same with the 7 and 15-year schedule. That started to phase out, and as noted with the Trump Tax Act that was passed earlier this year, he brought it all back, which really benefits real estate in a very meaningful way. It benefits a lot of industries. For those of us that can afford private jets, not me, that could be an area where you're getting additional depreciation benefits. But in this case, within real estate, you can take all of those losses. So if you had $1 million in the 5-year, $1 million in the 7-year, $1 million in the 15-year, out of that $7 million purchase price, you can push all of that into 2025 losses for properties that were bought and placed into service in 2025. So what does that mean? That means you invest $100,000 into one of BlackGate's shopping centers, for instance. Historically, based on how our cost segregation studies have been allocated, we've been able to see about a 50% 50% of that purchase price gets allocated into one of those 5, 7, or 15-year schedules that we can then take full advantage of in the year that we acquired that asset. So now your $100,000 investment, which is intended to cash flow and appreciate over time, you're getting $50,000 in this example of pass-through losses on your Form K-1, your tax form that we provide at the end of each year. How do you use that? Well, not only is it going to offset the income that we might be seeing from that property during this calendar year, But if you have other passive investments that are creating income for you, you can use it to offset that income as well. Again, this is a piece where you should be talking to your CPA, because there are different buckets of income as the IRS generally defines them: your active income, your passive income, your portfolio income. And each bucket, both losses and gains or income, kind of stay within that bucket. So if you're receiving a lot of passive losses, that can be used to offset other passive gains, reducing your total tax bill at the end of the year. But to continue this example, you've got your $100,000 initial investment. Oops. We're passing through, on average, about $50,000 of immediate deductions on your 2025 K1. That's going to offset the cash flow that we paid from you. So if it was a deal that we bought earlier in the year and we're paying out 6%, you've received $6,000 of income from us, of distributions, in a tax efficient manner, because those are deferred through part of those are covered from your $50,000 loss. And then you have an additional $44,000 of paper losses, again, that can either be used on other passive income or carried forward throughout the deal. So, again, you need to understand what your passive income portfolio looks like from your CPA or advisors. But that is a powerful tool that we see a lot of investors use, and can kind of recirculate money in a more tax efficient manner. Let's say they sold a rental property and reinvested those proceeds into another rental property where they're going to use bonus depreciation, or a syndication type investment to become a little more passive. They might have walked away with $150,000, we'll use the same example, $100,000 of net gain that would otherwise be taxable this year if they from that sale. But they can wipe off half of that or almost half of it, through that bonus depreciation that we're providing on our K1, because those both sit in the passive buckets, even though one was directly owned and one is more of a true passive investment, a limited partnership investment. And then we go to defer even further. So as I mentioned in the opening, any tax benefits, tax efficiencies, specifically to bonus depreciation or depreciation in general, when you sell a property, those come back. I'm happy to explain this in a little more detail, even share some personal K1s that I have here to sort of show how it's reducing your basis in the deal. But when we're giving you, let's say, $50,000 of bonus depreciation, if you use it, it is also showing up as a reduction in your basis. So now when your $100,000 investment from a tax perspective becomes a $50,000 investment. And then if we sell the property later for $200,000, it's not just the $100,000 gain, it would be a $150,000 gain because of that lower basis. A way to supercharge that and defer even further is to go into what's called a 1031 exchange. So this is something that, as far as I know, is very unique to real estate. And it allows investors, both active and passive, as we've offered it to our limited partners as well as we're moving through deals, a way to, we turn around a property, we add a lot of value. Let's say we buy it for $7 million, we fill up the property, we sell it a few years later for $10 million. So we've made a $3 million gain on from initial investment to sale for our investors. And those investors, their $100,000 turns into $200,000 net back to the investor. They don't want to pay the taxes on that. We have offered what's called a 1031 exchange, where we say, hey, you can take that $200,000 and roll it into the next BlackGate investment. And in doing so, we will continue to handle all the process in terms of running the deal day to day, finding the next deal, et cetera. But it allows you to roll that over in I'll call it tax-free, a tax-efficient manner. You're not going to owe the gain today and ultimately have to reinvest less money to cover that tax bill into the next deal. We can keep deferring all the capital gain. Compare that to, say, your stock portfolio, where once you sell a stock, and I'm not including all the tax loss harvesting and advanced techniques there, but if you have $100,000 portfolio in the stock market, it goes up to $200,000. You want to do something different with it. You sell off that $200,000 stake. Now you owe taxes on it. So you really only have, call it $160,000 left to actually invest. Through the 1031, it all in real estate, that 200 rolls over as $200,000 into the next deal. And now you can start growing that $200,000 in a more efficient way, assuming you find the right deal. There are some pieces to this that, again, in the passive world, the sponsor, BlackGate in this case, takes over. And that includes what I have on the right side of this presentation, where you've got to identify properties to potentially buy within a certain time frame. Then you have to go close on one or multiple of those properties within 180 days. And you have to make sure that you're finding good deals in a very timely manner to utilize the 1031 exchange. If you miss one of those deadlines, if the deals that you identified you don't actually close on, then you owe all the taxes. And there's some other fees that are associated with it. So ultimately, it can be a very powerful tool, particularly for the passive investors who are not doing the day-to-day work of having to source the next deal and then run the deal day in and day out. It can be a very powerful tool for those of you that are more active. But it obviously takes work there. Towards the bottom there, the ultimate strategy that I've spoken to several investors over my career in the commercial real estate space is the swap till you drop strategy, which is literally they intend to, because they're passive, so they get to live their life. They're not running the deals. They're not sourcing the deals. They're just, kind of identifying an investment opportunity and writing a check. And obviously, hopefully that pays off for them. But swap till you drop and pass it on tax-free is kind of what they've told me, where their intent is they're getting into these deals that look a lot like the BlackGate deals, where there's a true value add play. So you're getting strong returns because we're buying an undermanaged asset that's maybe 80% occupied. We're going to come in with our in-house leasing team, fill it up to 100% occupancy, turn around and sell it, create that large value gain. And instead of taking that money, they're just going to execute a 1031 exchange into the next deal, which probably happens about 5 years later on the typical BlackGate deal. Now, 5 years later comes, what are we going to do? Oh, we've got to swap again. But with their goal being to build up that principal balance and the cash flow, because again, real estate creates both cash flow and depreciation, that they can live off the cash flow without ever touching the principal balance, and while continuing to get stronger appreciation through buying turnaround deals over and over again. And in this case, as we'll step into the next slide, they want to keep doing that. They want to build up that passive income to the point where they can just pass the entire balance, the capital balance, all the investments, off to their heirs when they pass away. Obviously, that's going to take some time to build up for a lot of us, but that's the end goal, is to live off the passive income, let the appreciation grow, and even if it's selling, I can move over into the next deal at this without losing 35% of my profits, or 25% in long-term capital gains, to pay taxes each year, and having to kind of dip and rebuild with each sale. They can see that stronger trajectory of capital throughout their portfolio. With the end goal, of course, they're ultimately going to pass, of using step-up basis into when they pass off to their heirs. So again, the play here is definitely long-term, but in this instance, as you're getting towards potentially estate planning and exchanges of wealth, knock on wood, we're all fortunate to be in that type of position. The current tax code allows for the step-up basis, which means they may have invested $100,000 today. 40 years from now, that's Hopefully the investments have gone well. They've been averaging, really solid returns, both from the cash flow and the appreciation. And that's grown into a couple $1 million. Uh, when they pass away, while they've only invested 100K and let it grown, that step up basis now allows that all those deferred exchanges that they've used where they've never had to pay the taxes on it, well, it just resets to book value. The heirs, in theory, could sell it off at $2 million, which is the current book value, and don't owe any long-term capital gains because of that step up basis rule. Um, I will add in here all of the things that I've talked about thus far are based on current tax code. As we know, as we have all seen, things can change day to day or administration by administration. But a lot of these items, the 1031 exchange, step up basis, the depreciation rules, while they have maybe changed in some nuance, they've not gone away. And so if you want to take past experiences as predictors of the future, I could foresee these remaining on the books for quite a long time, if not indefinitely. Um, so that's kind of the biggest one. That step up basis, if you are going to utilize some type of tax deferral strategy over the long haul to create better transfers of wealth to future generations, however that's going to look, whether it be your kids or charities, um, you can ultimately utilize that. And the key driver to being able to do so, as I know some of you here on this call are either in retirement or nearing retirement. Um, it's all through creating that passive income. If you have the income coming through, and again, this is real estate, this could be a stock portfolio with dividends, um, you know, even a bond portfolio. But if you have that recurring income coming off the property or coming off the investments that isn't hurting the growth opportunities of that investment, then you can start to create that passive income that is sustaining your lifestyle, allowing you to do the travel and the other lifestyle events that you prefer without having to touch the principal and allowing that to continue growing. And within real estate, I view that as one of the best kind of investment strategies for that, just because the more income it's creating, the more it's valued. Where the quote unquote traditional stock play is your dividend stocks are low growth and your growth stocks don't pay dividends. Um, and then to continue on here, so you're creating that passive income stream, and then ultimately moving into some more estate structures that could help as well. Not something I'm a huge expert on, but wanted to bring it up because this could be a good conversation as you're starting to get into that, to talk with your wealth advisor, your tax advisor, and really understanding how you can start to move some of these holdings, whether again it be private real estate holdings, active real estate holdings, or stock portfolios into different entities, whether it be LLCs, family partnerships, revocable or irrevocable trusts that can help some of that efficiency as well. And ultimately, with the end play of for you, the listener, to create your own financial freedom and potentially financial abundance, if that's your goal, and to help create the legacy that you're looking to create for your loved ones, whether that be family directly, friends, causes that are close to your heart. So, what should you be doing now? I would love to say you should invest in this next deal in BlackGate. Unfortunately, we don't have one. Um, but you should be really starting to do this planning if you haven't already. I had my kind of year-end tax call with my accountant literally 3 hours ago, and just kind of start to lay out so that we can make some moves in terms of, IRA contributions, other types of ways to help reduce the tax bill that honestly sit outside of real estate. But within the real estate world, really starting to assess, what are your options? Are you going to hold properties? If you are a passive investor already, have you talked to your sponsors about whether any deals are going to be closing before the end of the year? because sometimes, and I've had these conversations as well, they happen without much advanced warning. And so if you are looking to maximize the tax efficiencies there, is that sponsor going to potentially offer a 1031 exchange to roll you over in a tax efficient manner? And if not, are you going to have another investment opportunity that can help offset those gains before the end of the tax year? So it is still, normally there's still time to get into some of those, but really making sure you're planning ahead. Reviewing those K1s, again, understanding if there were any outside major capital events that are going to impact things on your tax reporting, and understanding what your basis is if you have multiple real estate deals that have some carry forward pass through or depreciation losses, and you do potentially have a sale that was unexpected on December 20th. Do you have enough to shield those gains and kind of do the quote unquote lazy man's 1031, where you're using built up reserves in depreciation to offset that gain so that you're not forced into making a bad investment decision just for the tax purposes before the end of the year? For anything that you have control over is, coordinating that exchange timing. I had a call yesterday with an investor who has sold a big portfolio of industrial buildings, and they are trying to coordinate into getting into some retail investments, personally, because they really like it and they love to use their 1031 exchange money. There are some implications if you're coming in as a passive investor with those 1031s, and not everybody will accept them, or they won't accept every dollar amount, but there are those out there. So again, aligning that and making sure, hey, is the next deal going to hit if I go this passive route before that 180-day close, or have I even identified it on my 45-day requirements through that 1031 process? And then one of the best ways that I didn't hit on earlier, because it's not so much a tax shielding uh, opportunity, I guess it kind of is refinancing opportunities. These can happen throughout the year, but another powerful benefit of real estate in general is that when you build up the value of the real estate and you go back to your lender and say, I want to refi this. And again, this can be a single family home, your primary, or an investment property. It can be a retail center like BlackGate owns. It can be an apartment complex. But when you refi a property and there's cash to be pulled out of it, those dollars are, we'll call it tax free. And it's because it's debt. It ultimately has to be paid back to the lender. But in terms of building a portfolio, and especially leveraging a portfolio to be able to scale it into something much bigger, using that tied up equity through a refi to to go buy potentially another property or reinvest into another deal, it both creates liquidity out of this investment without actually getting rid of the investment or creating a tax event, while allowing you to reapply that into another investment that hopefully is outweighing the additional interest expense that you might have from that refi. But as it says, a lot of this, all of this planning, whether it be doing the cost segregation studies and taking advantage of the bonus depreciation, whether it's ultimately getting to sales and 1031 exchanges, or even refis, it all comes down to planning and watching what you're doing. There are powerful tools within real estate that I think are unique or almost unique specifically to real estate, that can help mitigate that quote unquote 35% outflow each year for the taxes. Um, but it takes understanding some of what you're looking for. So just to recap, the you're ultimately starting with depreciation. Real estate creates cash flow and appreciates. The more cash flow you create, typically the more valuable the real estate is. You can offset that with your depreciation, just your straight line, kind of bare bones basic. You can take it to the next tier with your cost segregation study, which does cost some money to have a professional engineer that focuses on this to make sure you're not opening the door for major audit risks. But you can start to accelerate that into reclassifying parts of that purchase price in the 5, 7, 15 year and getting that a little bit sooner. Next step up is going to be that bonus depreciation, which allows you to take a lot of that depreciation expense today to offset both anything that's happening this calendar, really across your passive income, passive portfolio can offset a lot of potential tax liability there. And then as you're fast forwarding and getting to the point of, all right, I'm ready to move from this asset, I've gotten everything I can out of it, into the next one, utilizing that 1031 exchange. And ultimately, if you go take that out to perpetuity for each of our lifetime, you get into that step up basis. And, it comes down to the bottom quote. It's not just about building the wealth, it is definitely about keeping it. And the more you can retain control of, primarily through not paying to taxes, the faster and more you have to continue to compound upon itself. So, what are your next steps? I will be sending both this webinar, the actual recording, and the presentation itself to you. They'll get sent via email tomorrow. I'm going to send the presentation because it is kind of wordy. I hope I summarized it and used some more better examples. But I think it could, for me, it would be valuable to look through it instead of just watching it and recording. And as I opened with, this is not a here's your tax advice. This is hopefully educational to help you understand different ways or questions you can ask of your professional, your CPA, your wealth advisor, whoever that might be, to potentially align and utilize things that they might not be familiar with. Um, Quick anecdote is I have spoken to investors who, in this specific area of real estate, seem to know more than what their CPAs are. And I'm not out there condoning that you switch CPAs to maximize these tax losses. You need to find somebody you trust. But it is good to ask and understand because these are tools that are available to a lot of people in different ways. And sometimes it is worth, shopping around to see if there's somebody that understands moves you want to make a little bit better. Second, what just happened to my screen? Uh, Sorry. Second, as I noted, this is the second of my monthly webinar series, but we will be having another one each month. They tend to be about, what's this, the third Wednesday of the month, avoiding any major holidays. So our next one is scheduled for December 17th at noon Eastern time. Again, will be recorded. You will get email reminders, but always recommend that you mark your calendar now and look for that invite coming soon. And third, as you can see at the bottom there, bottom right, there's all my contact information. That's my cell phone number, my email address. You can call, text, email me, and always happy to continue conversations. Like I said, I didn't share any of my personal K1s here. Happy to share a little bit more of that in a slightly less public environment and share my experiences, my direct experiences, and how I personally have seen the power of this. A lot of this real estate tax efficiencies benefit my own personal situation. My last anecdote is, based on my adjusted gross income last year, I think my effective tax rate was about 7%. Um, and that adjusted gross income was definitely less than what we kind of budget to live off of. So would reach out directly and happy to have those personal anecdotes, share any advice that I might be able to move you in the right direction. And with that, I will keep it open for questions and answers. You can click down below. There should be a Q&A button to submit your question, and we'll stay on as long as I need to have those come through. But the first one here is, do you underwrite what returns look like taking into account depreciation assumptions? Thank you for that question. So when you're looking at a BlackGate offering and we are sharing our projected returns, I'm going to stop sharing my screen here. Let you see me a little bit better. We do not. So it's good to understand that the example I'd used earlier, that 50% range of that net pass-through loss, is something that we have historically seen. It tends to be a range because each asset, each cost segregation study is going to be a little bit unique there. And then, as noted, I've worked for several sponsors. I'm in more LP positions than I am, so kind of having a combination of experiences there. I have not seen any, if I don't believe I've seen any groups that do that. Maybe they do it from a marketing standpoint of, oh, look at, we're paying out 8%, and that's kind of like getting a 12% return in a taxable type investment because of that offset. But as I opened up with, the ability for you to use depreciation and at what time is very individualized based on your specific portfolio and what kind of buckets you have flowing in, whether it be all active income with one LP investment. You're probably not going to be able to take advantage of a lot of, uh, or I should say, one passive investment. You're not going to be able to take advantage of a lot of that depreciation just because there's not enough in there. You don't lose it, it rolls forward and can, again, mitigate how much loss or how much your taxable basis is on the back end. But to to me, it's almost a red flag if I see a sponsor pushing too hard on the tax benefits, because again, they don't know my situation, and so I might not be able to use any of it. And if you're only sharing the what that looks like net of depreciation, that doesn't help me. And it's kind of, the reason I see it as a red flag is it's a bit of the over promise under deliver type mentality. Without keeping you all online to wait for more and more questions, I definitely appreciate. I was either very thorough or I bored you out of your mind, and therefore you all left and didn't have any questions. But definitely happy to address those. Like I said, I will be sending out an email with the presentation, with the recording. Of course, that email will have all of my contact information on it. So if you do have any questions that arise, please feel free to reach out. And just to plant some seeds with that, that's anything from, I've shared who I use as my CPA. Not to say it's the best one for you, uh, but have made those introductions to, if it comes down to it, you're wanting to see sample K1s of how this all gets reflected in terms of distributions and where the depreciation sits and how it affects your basis and all that stuff. Happy to do so as well. But please reach out, and definitely look forward to talking more about in future webinars. And if you have direct questions about this topic, more about this topic. And with that, you guys have a great rest of your day. Thank you so much.